Hey everybody, welcome to this free edition of our Trader User Group, a weekly roundup for the trading week ending June 10th, 2022. I'm Preston Brent. Thanks for tuning in. This week's theme is Can You Feel the Heat? Well, we had a really interesting week. Market started off a little bit positive, but then turned dramatically negative with some key economic data coming across the wires. Let's talk about it. So, if we just take a look at this week, let me just put up here the weekly sound bites. We'll put the index performance right up here. You can see everybody was very solidly in the red. The Dow, S&P, Nasdaq, Russell, everybody at a minimum in correction territory. S&P is close to being in a bear market. Dow in correction, Nasdaq and Russell both in a bear market. The Russell, even though it's showing it's down 19.8%, that's just year to date. It actually started going lower back in Q4 of last year. So everybody is just having a tough week. Even the best sector, energy, still came in just slightly underwater at 89 bips. Year to date, the best sector performer is still energy at 61%. Discretionary is bringing up the rear at almost 30%, 29% below water. You can see the forward PE ratio is down to about 17.5. You can see the dividend yield in the S&Ps at 158. Treasury went up to a whopping 3.16. So Treasury's moved up a pretty good bit this week. S&P earnings yield still sitting at about 5.24%. The S&P yield over Treasury is about 2%. The real yield, when we factor in that horrible CPI number that came in on Friday, the real yield is still a negative 3.36%. So investors, consumers are still getting hit hard with that inflationary hit that came in. Current VIX, it was up for the week, closed in at 27.75, which to me is a little bit surprising, but not really. I've been telling our members all year long, I know a lot of folks on TV are saying they're waiting for a VIX 40 plus print to kind of show capitulation. But this market has been moving lower all year long. We're not getting those big volatility pops that we got around COVID or around the last bear market or around Volmageddon back in 2018, 2019. We're just not seeing that. This is more of a slow, orderly move lower as rates go up, valuations get reduced, stock prices go down. Nasdaq being heavily influenced by technologies getting hit the hardest. I still think we got more downside to go. Okay. The CPI, as I said on Friday, came in hotter than people were expecting. And on top of all that, we're seeing some retailers guiding profit estimates lower, like Target and a few others. Target's for the second time they've guided their earnings lower. Same thing with Walmart. But the headline number for the week, the CPI came in at 8.6% from a year earlier. Most people were expecting it to come in at 8.3. So that does show that peak inflation hasn't really peaked yet. The hope was that the prior March, when it came in at 8.5, that it had peaked because it came from 8.5 to 8.3 in April, but then it shot right back up to 8.6% this past month in May. Keep in mind, inflation, the CPI data is a lagging indicator, so that tells me it can still go higher. Core CPI, which excludes energy and food, which is what the Feds use, even climbed 6% from a year ago. That's also faster than consensus estimate as well. And in the sign, the labor markets may be loosening up just a little bit. Weekly jobless claims increased and hit their highest level since January this year. So, and if all that's not enough, the University of Michigan Consumer Confidence Survey showed the most downbeat sentiment on record. So, all in all, it really wasn't a good week for the markets and price action. Okay. The acceleration that I talked about in the CPI is keeping a lot of pressure on the Feds to raise their rates. Now, the markets have already priced in a 50 basis point rate hike. That's 0.5% coming up this coming Wednesday. And another 50 basis point rate hike in July. But they had backed off to a 25 basis point rate hike for the second half of the year. But now the markets are pricing in, well, that could be 50 basis points, maybe two more 50 basis points before the end of the year, going into 2023, where the futures market is looking for 2 additional quarter point hikes in 2023, taking the Fed's policy target rate to anywhere from 3.5 to 3.75%. So that adds a lot of hawkishness with that CPI print. Now, all it took is just one CPI print. The Feds, as you know, haven't done anything yet. But markets being what markets are, they don't wait. They shoot first and aim later. So they're pricing in all these additional hawkish rate hikes by the Feds. So this coming Wednesday of next week, it is Fed week, and everybody's going to be paying attention to what the Feds are going to do. Not so much are they going to hike the rates 50 basis points. They're on record as saying that's what they're going to do. I even saw some folks on TV saying they could probably go up to 75 or 100 basis points, which is 1 full point interest rate. But they're not going to do that. They've already telecast 50%. What the markets are going to be looking for is what Boom Boom Powell, that would be Jerome Power Ranger Boom Boom Powell, says at his press conference. That is where the markets want to know. Just are they going to be more aggressive in the second half of this year or kind of keep policy the same? That's what's going to move the markets up or down a good deal on Wednesday. So it's going to be a very interesting week. Now, if we come over and look at what's going on across the pond here, and if we look at Europe, you can see Europe's all in the red this week as well. The FTSE finally gave up their year-to-date being in the green, and they moved into the red, just 91 basis points. But everybody's in the red across Europe. The Euro Stocks, which is the 50 largest companies in Europe, the FTSE CAC 40, the French index, and DAX, the German. They're all in the red for this year. All right. The ECB, not to be left outshone by the Fed, suggested it may increase interest rates at a faster than expected pace after July. Now, they signaled that it plans to start raising its key deposit rate, which right now is at a negative 50 basis points, by a quarter point in July. All right, that's not that aggressive. But they did also add in their statement that if the medium-term inflation outlook persists or deteriorates, then a larger increment will be appropriate at their September meeting. So they're still being a little bit more dovish than our Feds are being. But they did confirm that it would end their net purchases of bonds under their version of the asset buying program in the month of July. Okay, they also called for their economy across the 19 countries that make up the ECB to expand 2.8% this year, and that's down from a whopping 3.7%. So that's a big, 70 basis point reduction, or actually a 90 basis point reduction in their forecast in just 12 months. They also show the economic growth slowing to 2.1% in 23 and 24. So anytime you see a central bank go out and have a prognostication greater than 6 months, I kind of discard it. Although the markets, it adds fuel to the fire on whether the central bank's going to be more hawkish or more dovish based on their forecast. So we're going to get this as it washes ashore to the U.S. markets as well. And then, of course, if we look over in the Asian markets, it was all in the green. Nikkei, China, Hang Seng, primarily because over in Japan, the Nikkei was up 23 basis points, still in the red year to date. But Japan, they're now opening from strict lockdown, so they're getting a little bit of tourism boost in their markets. Their economic growth, though, is still below pre-pandemic levels, so the Bank of Japan is still one of the few central banks that's putting stimulus into the economy rather than taking it out. Same thing with China, right? They're slowly starting to open up from their zero COVID policy, which I think is just idiotic, but that's China. But also, in addition, like Japan, they're also coming out with more stimulus, a looser monetary policy. So that is helping their markets. And of course, coming from 100% shutdown in key cities across their country, exports grew once they started to open it up to double-digit pace. And they're expanding. Their imports are expanding for the first time in 3 months, naturally, because they've been shut down for about 6 weeks, going back to March. So factories are reopening, supply chain issues are starting to improve. Now that is going to wash ashore to European and U.S. markets, but probably in another 60 to 90 days. It takes a little bit of time for this to kind of work out some of the supply chain kinks. which tells me that we're still under some supply chain kinks right now over there with their huge draconian shutdown policies. Now, what I want to do is just shift our screen just a little bit. I'm going to take you over. We're going to take a look at the SPX, the cash index. We're going to look at a weekly chart. It'll take a second or two to come up on your screen. But this is the same chart I've been showing our members and showing you guys each weekend for the past month and a half or two. You can see here that I've got both extension and retracements on key pivot points, and then I've got superimposed on it an Andrews pitchfork. Most people don't know how to use it, nor do they even use it. I use it for longer term charts, as I say, this case a weekly, and it shows a secular bull market. That blue line kind of gives me a secular bull market approach. So even though we can go into official bear market territory, that would be a cyclical bear, but a secular bull because we're still in this bull market. Once we go below the 3650 into 3600, now we're starting to break down that secular bull market, and then all bets are off. But you can see here what I call areas of congruency. That's when you get different technical indicators lining up with each other. So that would be an extension and a retracement, both lining up right around that 3850 to 3825 area. And that is, I've always said that our baseline is about 3800, right? Down to about 3700. I may extend it down to about 3675, but you can call it 3700. But that is going to be our range, right? Because we've got a lot of resistance there. Should this break, next level down is 3,500. And we can get down there if inflation stays higher and the Feds come out more hawkish. Okay. The markets already have priced in more rate hikes in the second half of this year. So we could get a situation where the Feds don't change their policy. They come out and they say what they said last meeting, 50 basis point rate hike next Wednesday, another 50 basis point rate hike in July. And then we're going to sit back and we'll stand ready to do what we need to do, even if it means pause or go stronger in the second half of the year. That would be surprisingly bullish for price action because it's already been priced in that they're going to be more hawkish. If they are coming out the same as they were before, then I believe we'll get that bounce back up again. And then on the overhead side, I'm looking at about 4,200 to 4,133. If we look at these prior bull traps, right? Here was one bull trap. There's another bull trap. Both of them over 400 points in a bull trap mode, right? This was another one right here. All of these bull traps, and if I were to simulate another bull trap here, that puts us from 42 to 4,300. Okay, so that would be right at that level right there before we run into resistance. But I'm calling resistance up here at 4133 to 4200. So say 41 to 4200 would put us right there. So we're in this game right here, this action right here. We will break one of these levels. The odds favor a downside break, taking us down below 3800, possibly into this range right here down to 3675. All right, now I've had a 3800 down to 3,700 target range most of the year. All right, that's where I was calling for it. And we did come down and almost get into a bear market hitting 3,800 in the SPX, but not quite. Okay, it was an intraday move. Now, if I let me clean up the screen, and I'm going to take you over to another chart here. Let's just do this like this. Let me turn my pen off here for a second so I can move things around on the screen. If we come in here and we look at this, that's what I've got. Let's take a look at this chart right here. All right, so looking at this chart, notice this is a daily chart of the E-mini futures, the S&P futures. You can see a 3, 4, 5 leg. My projection for the 5 leg down is about 37.23. All right, now that's just a Fibonacci extension off of this range right here. But my system will calculate it for me. Throwing in Elliott wave, giving me an Elliott wave 5 right here. And it also, if you'll look down, you'll see it projects another Elliott wave 5, an even lower 5 down around the 3,500 level. So if the Feds come out and they increase their hawkishness from the last meeting, then I think we got more downside. If they come out and leave it exactly like they've left it before, because the markets have priced in more hawkishness, then we could get a little bit of bounce. But be very careful. The other thing I'm going to show you in this chart is look at this red line right here. That red line is the 50 EMA, right? Now, if you look at it, this is a bear market chart, as I tell you guys every weekend. A bear market chart, even though we're not officially in a bear market, is kind of an arbitrary number in my mind. But when the 50 crosses the 200 EMA, both of them EMAs, you can see the challenge at the 50 EMA right here. We could not get over it. Intraday, yes. Close, no. And then we just gave it all up and rolled over. Okay. Just a really bad sign. Okay. And this is why we can come down and approach our May 20th low here when we were intraday down 20.81%. Now you can see we closed back up. And we were, I think for the day when we closed, we were at 19 and some change, 19% and some change. So we never officially closed in an official bear market, but I think that's going to change, right? We're going to roll back over. That's where the odds favor a move at this point in time. And then, of course, if you look at Nasdaq right here, Nasdaq is coming down. I got a target in Nasdaq of about 11,200 Nasdaq futures. We got an Elliott wave 345. Notice we could not get over the 50 EMA. Understand, in a bear market chart, a bear chart, I guess if you want to say the same thing, the 50 is always below the 200, and the first challenge is the 50. If it beats the 50, next challenge is the 200. Oftentimes, price action will be stuck between the 50 and the 200, and then wherever it breaks is where you want to run and lean. Right now, we can't even get over the 50 in both the S&P 500 and Nasdaq. If we look at the Dow, you're going to notice the Dow pretty much gave up, and it was down 825 points. It gave up big time the 50 EMA. Now, the Dow was challenged over the 50 EMA one day, below, over, below, right at, below. So again, the 50 EMA is challenging the Dow, and the Dow is the strongest of the indexes, but it gave it all up finally and rolled back over again. And then one final is the Russell. If we look at the Russell, you'll see it could not. Again, holding the 50 EMA, and then we closed one day above it, no follow through, and we roll right back over again. You can see these moves lower. This was my original target right here. We hit it perfectly. Now I've got a new revised target over here of around 1650. So my original target we hit perfectly. We got a bounce. It's a 3-4-5 Elliott wave pattern. Typically what we'll do is come down and hit the target level of this 3-4-5, giving me a little bit lower move here. So every single index is indicating more downside action. Does not mean it's going to happen, but I give it over a 60-65% shot that that's the way you want to play it. Okay, now next week is going to be a really wild ass week because we do get the Feds and Boom Boom Powell on Wednesday. Keep in mind, we have not heard from the Feds. Just like corporate earnings, they have a 10-day quiet period where no Fed governor, voting member, or Fed for that matter is allowed to get to the press and talk 10 days before their meeting. So that would put us last week. That's why it's been very quiet. After their meeting, they all rush to the microphone to say something pithy. All right. So this is kind of where we're sitting here on all these charts. If we look at the VIX, you can see the VIX was in a downbeat lower, just a steady move lower as price action has just been moving lower. And then it finally got a little bit of a pop. Intraday, it moved up to about 29.63. And it did finish up, but it's not aggressive, but you can see the 50s over the 200. So like a bear chart in an index, this is just the opposite. It's a bear chart where the 50 EMA is over the 200 And I want to see if that 50 EMA can hold. You can see here it provided resistance, which is more bullish for the markets, and then it finally gave it up. The 200 is providing support for the VIX right now. Okay. If we look at treasuries, well, bonds sold off more. You can see bonds are going down to my target level. I got a 345. My target for bonds is around 133. I've revised it lower. I came out Q4 of last year and said you got to short bonds or you got to pick up puts and TLT and then just forget about it. You'll make money in it. A lot of our members have made a killing on it. Okay. And that's kind of where I see it going. Interest rates, by the same token, are moving higher. Look at this. My target for interest rates is 3.3. All right, we closed out at 3.156. We're near, actually, let me just look at this right here. I think we hit 2022 highs right here, but we're in this zone right here. You know, it's a little bit of a whoops. We're in this zone right here of 2022 highs. But I do believe we're going to go up higher, guys. It's a 3, 4, 5 pattern, but that doesn't mean the 5 leg can't go up higher, right? And that's kind of what I'm looking at here. So interest rates going higher, that's doing wonders for the US dollar. If we come down and look at the dollar, all right, it was up big time on Friday. It is like the safe trade right now. You can see where the dollar found support at the 50 EMA, and it's just been steadily grinding higher. Ideally, I'd love it to take out 2022 highs, and then I'm going long the euro, right? The euro kind of came down hard, even though the ECB came out and talked about a rising interest rate environment over in Europe. It is viewed that their economy is a lot worse than the U.S. They fared worse last year, and they are improving, but they're still a lot lower than where we were from a pre-pandemic level. So Europe's not doing that good. If we look at the euro, with that big move up here, the euro came down pretty hard, right? You can see here, see the 50 EMA? We have not been able to get over the 50 EMA. I mean, we sat here for almost 3 weeks. This is a daily chart. Could not get up above it. That was my original target, which is now resistance. I want to see us climb over the 50 EMA, test it, hold it, and go higher, and then we're going to have a nice run up to $1.10 or $1.20. You can see this level here, and if I just calculate an extension right here, it is saying that we won't go down to parity, but things could get worse where the euro goes down to 102. If we get down here, I'm going to be picking up the euro. It'll be a low-hanging fruit trade. Right now, I'm just going to let it run. Okay, that's kind of how I'm looking at that one. Then, of course, gold absolutely loves higher inflation. You can see gold moved up here, but again, the way we're trading gold for our members, there's only one way to trade this precious metal right now. Trading it day to day, swing trading is not good. Day trading, you can trade gold day trading, but swing trading is very difficult because you're just getting a lot of chop in here. Okay, a ton of chop. Same thing with silver. If we take a look at silver again, just get it on the screen here for you guys. You can see silver well below the 50 EMA. The 50 EMA is below the 200 EMA, so it is a bear chart. Going back to the gold chart, you can see here in gold, the 50 is over the 200, so it is a bull chart still. But it's very rare that you see a bear chart on silver and a bull chart on gold or vice versa. These two will self-correct and get back in alignment again. I do believe that alignment is going to force silver to the upside more so than gold. So that would be the play I would take if I wanted to play it. Okay. Energy, of course, there's only one way to trade oil right now. You can say directionally up, but it'd be very difficult for you directionally up in the futures market to go from 115 to intraday down to 105. That's a 10-point move in 3 days. If you're trading that in options, you're going to get hurt. There's another better way to trade oil, and you got a high probability way of making money. And that's what our members are doing. Where can oil go? I think it's got more upside here. So we'll see it kind of come up a little bit higher, peter out. I'm seeing gold or oil forecast $1.30 to $1.50. And with our method, we can make money on it, right? And they're not credit spreads because you can get blown out in oil and credit spreads. A $10 move, if it moves against you in a credit spread, you're going to be underwater so quick you're going to have to shut the trade down. So that's a little bit about what I got with oil. Nat gas, well, basically we're long nat gas. You can see here that it's getting harder and harder to move up more. But I do believe we're going to kind of find a peak up here and come back down and test the 50 EMA again with natural gas. Gasoline, well, gasoline is on fire, right? You can see we're at a 2022 high. I think gasoline prices over the summer months are forecast to go a little bit higher. But remember, what you see at the pump is different than the futures market. The futures market is about 90 days ahead of the pump. So we can see a peak in falling gasoline futures while the gas at the pump is going up. There's that lag there. So I wouldn't be ready to short this yet. There is no divergence here in this trade. But there's going to be an opportunity to have a nice downside play in gasoline, but just not right now. Okay. Now there's other trades in the ag market and a few others our members are taking. Members, I'll review that with you this Sunday evening for our weekly market watch. If you are not a member in our group, I highly encourage you to come in. We're doing really well, especially in the commodity side, but we're also making money on index trading and on precious metals. Obviously, we got a nice way to trade that. All right, everybody, have a really great weekend. Members, I'll see you this Sunday evening for our weekly market watch. Take care, everybody. Ciao.